Ladies and gentlemen, good day and welcome to the Apollo Tyres conference call. I am Rishi Vora, analyst with the auto sector at Kotak Institutional Equities. At the outset, I would like to thank the Apollo Tyres management for giving us an opportunity to host this call. From the management team, we have with us Mr. Neeraj Kanwar, Managing Director and Vice Chairman of Apollo Tyres, Mr. Gaurav Kumar, Chief Financial Officer, and the Investor Relations team. We will start the call with brief opening remarks from the management team, and then we'll begin the Q&A session. Over to you, Neeraj sir.
Thank you. Good afternoon, and thank you for joining us today. I welcome you all to the Apollo Tyres Q1 FY26 results conference call. As always, I would start with a broad overview of the results, followed by Gaurav, and then we would be happy to take some questions. We closed Q1 FY26 with a consolidated top-line growth of nearly 3.6% Y-on-Y and an EBITDA margin of 13.2%. On the domestic India front, we saw growth in the OEM segment coupled with a modest growth in the replacement segment. The OEM growth was led by pre-buying on account of the mandatory AC cabin regulation in the heavy commercial segment. Coming to Europe, the demand environment was challenging, which led to a decline in the industry volumes in key categories. While we maintained our top line on Y-on-Y basis, despite the weak demand scenario, sequential decline in revenue was registered in Europe on account of seasonality. We are keeping a close watch on the market and will continue to focus on profitable growth through new product launches, premiumization of our product mix, and cost optimization. As highlighted in my previous earnings call, we remain committed to free cash flow generation and improvement in return ratios. I'm pleased to share that we reduced our consolidated net debt by over 15% in Q1 compared to Q4 of last year, which has further strengthened our balance sheet. Looking ahead, we anticipate a stronger top-line growth in both India and Europe. In India, this growth is likely to be led by the replacement segment. Let me now talk about key pillars of our vision and, as always, highlight some of the work done by teams in the quarter. Beginning with R&D, I'm pleased to announce that we have recently received approvals for supplies to a prominent German passenger vehicle manufacturer in both India and Europe. This reinforces our product strengths, deepens our ties with premium automotive players, enhances our OE portfolio, and further positions our brands in the premium segment. We are excited on the launch of our ultra-high performance tire, Apollo Aspire 5, built for the premium car and SUV category. Our dual brand strategy is paying off with our premium brand Vredestein, continuing to make rapid strides and once again recording highest ever volumes in Q1. Sustainability has always been a key pillar for us. I'm delighted to share that we have achieved a 35% reduction in Scope 1 and 39% reduction in Scope 2 emissions intensity, surpassing our FY26 emission reduction targets. Apollo Tyres obtained its first ISCC certification for its facility in Hungary in May 2025. The achievement is a significant milestone for us as it will facilitate the monitoring of sustainability throughout the process and supply chain, from the sourcing of raw materials to the final products. We earned a gold rating from EcoVadis, placing Apollo Tyres in the top 5% globally in business sustainability ratings. With this, I'll conclude my opening remarks, but let me once again emphasize that, as always, we are closely monitoring market trends and our cost structures with a continued focus on driving sustainable and profitable growth. We are proactively preparing to navigate both the challenges and opportunities ahead, and I firmly believe we are well positioned to capitalize on long-term opportunities across our core markets. Thank you once again for your time, and I'll hand over to Gaurav now. Thank you.
Thank you, Neeraj. And good afternoon, ladies and gentlemen. Continuing from where Neeraj left, let me share some further details of our operations for the last quarter. The consolidated revenue for the quarter stood at rupees 65.6 billion, a growth of 3.6% over the same quarter last year. The consolidated EBITDA for the quarter stood at rupees 8.7 billion, a margin, as Neeraj mentioned, of 13.2%, a slight improvement compared to the 13% in last quarter, but still lower than the 14.4% in the same quarter last year. Coming to the balance sheet, we have been able to further improve our leverage ratio given the focus on cash flows and profitability. Compared to the previous quarter end, we reduced our consolidated net debt by rupees 3.9 billion in the Q1, bringing it to a level of rupees 21 billion. The net debt to EBITDA for the consolidated operations stood at 0.67x at the end of June 25. In India, the revenue for the quarter was rupees 47.3 billion, a growth of 3% over the same quarter last year. The EBITDA for the quarter stood at rupees 6.4 billion, a margin of 13.6%, a substantial improvement compared to the 11.2% in the last quarter. Our volume growth in this quarter on a Y-on-Y basis was flattish, led by a low single-digit growth in replacement, a mid-single-digit growth in the OE volumes, which was negated by a significant decline in exports. On the OE side, while there was good growth in the truck OEM volumes, we had a decline in the passenger car OEM volumes. The margin improvement was a result of a decline in the raw material cost, also resulting in improvement in gross margins. Regarding the demand outlook, we expect the demand momentum to improve in the second half of the fiscal and the rebound in infrastructure and mining segments post-monsoon. Moving on the raw material outlook, we expect the raw material cost to be slightly lower in Q2 vis-a-vis the current levels. However, with a bit of uncertainty given on the exchange rates that is currently prevailing. Coming to the balance sheet, the large part of the debt reduction was in the standalone net debt, rupees 3.8 billion, as on June 25 compared to previous quarter end. And for India operations, the net debt to EBITDA stood at 1x compared to 1.2x as of previous quarter. For Europe operations, revenue for the quarter was euro 146 million, flattish over the same period last year. The revenues, however, were significantly lower than the previous quarter due to a weak market, which saw negative growth in all product categories and the seasonality factor. We performed better than the market in the critical segment of passenger car replacement tires, but were still in the negative territory. The EBITDA for the quarter stood at euro 16 million, with an EBITDA margin performance of 10.8% compared to 13.7% for the same quarter last year. The margins were impacted due to the impact on revenue, a negative market growth across product segments, and this had an adverse operating leverage impact. Looking ahead, we expect an improvement in the demand momentum, but we will continue our focus on cost optimization. Further to our announcement about the intended decision to close production and production-related activities at our Enschede plant in the summer of 2026, the matter continues under the Works Council consultation process. In the results, you would have seen that there is an exceptional item below EBITDA level, which is related to the estimated cost of this restructuring to the tune of rupees 3.7 billion, which is based on the signed social plan for payout to the employees. This payout would be in FY27, which is the next fiscal year, but the need to take this provision right now was dictated by the accounting standards. We continue to closely watch our CapEx outflow. There is no change in our CapEx guidance for FY26. Profitability, free cash flow generation, and improvement in return ratios continue to be our focus areas for our strategy as we go ahead. With this, I would conclude my opening comments. Thank you. We would be happy to take your questions now.
Thank you, Gaurav. We'll now open the floor for Q&A session. Anyone who wishes to ask a question can please use the raise hand option Once you are done asking your question, please lower your hand. We will wait for a couple of seconds for question queue to assemble. First question is from Siddhartha. Siddhartha, you can unmute your line and go ahead.
Yeah, hi sir. Thanks for
Hi,
the
Siddharth.
Sir, my first question is on the India business. If you can first share for the replacement side, what is the segment-wise breakup between PCR, TBR, and going ahead, how should you think about the full year growth? I mean, last quarter we had expected probably a better growth in this current quarter, but given the way things are on the demand side, how do you think we should expect the overall growth to be for the year?
Siddharth, yes, we had expected better growth when we began the year in our commentary of May. We believe that on the replacement side, we've performed in line with the market. OEM, as I mentioned, we've lost some bit on the passenger car side based on the accounts that we walked away. And exports, the peers may have outperformed us. I would say the top line growth, while we would still be pushing for a double digit, but maybe a high single digit would be a more realistic estimate.
This is on the volume side, right? Or
Right now, there is hardly likely to be pricing action given that the raw material cycle is reversed.
got it. Got it. And second question is on the commodities. So again, I mean, on a sequential basis, actually commodities haven't actually fallen as much compared to the 4% nearly drop QOQ, which we have seen per ton basis. So any other reason why this has been so sudden, this, and whether is this sustainable going ahead?
I'm not sure I get your question as to where you're talking about the 4%. The raw material did come down on a sequential basis.
Yeah, I was talking about per ton, sir. RM per ton is down around 4% QOQ. So we had expected a flattish to a marginal decline probably when we started. So is this fully reflective of the current prices, or should we expect more improvement going ahead?
As I mentioned, we expect Q2 raw material, unless we get significantly surprised on the USD rupee exchange rate, we expect Q2 raw material to come a little further down.
Understood, sir. So lastly, on the Europe side, I mean, the margins really have come down despite on a YOY basis. Revenues actually are flat. So any other reason? I mean, operating leverage should not be the case if revenues are on a flat on a YOY basis, but we still have seen a correction in the margins. So any further thing why it has happened?
See, there has been inflationary pressures, and as we've mentioned in the last few calls, that in the last couple of years, the inflationary pressure in Europe has been higher than normal, whether it's the energy prices, salary prices, etc. And that's one of the causes which has led to our decision on the Netherlands side. So the cost part has kept pushing up. And particularly from a sequential basis, there was a big revenue decline.
Got it. So we have not done any pricing changes in our products. So is that the right assumption?
Yes, there has been no pricing changes.
Okay.
There were certain price cuts taken towards last quarter, which is Q4, in line with raw materials coming down.
Okay, understood. Thanks a lot, sir. I'll come back in the.
Thank you, Siddharth.
Thank you, Siddharth. Amin, you can unmute your line and go ahead.
Hi, am I audible?
I mean,
Hi.
yes, Amin.
Hi. Okay, so one question was, on the similar lines that Siddharth asked on the Europe margins. So, would it be fair to say that the inflationary pressure that you're seeing in Netherlands is higher than Hungary, or is it the same? I'm just trying to understand that, as we move on to Hungary as being our sole supply base, in addition to the reduction that we will see in production costs, is there a difference in the inflationary pressure also in these two geographies, or is it the same?
It is mostly similar, I mean. The big pressure Y on Y, to again touch on the point Siddharth asked and you've said, on a Y on Y basis, the raw materials were up 3% in Europe.
Okay.
So that's sort of eating at the margins with the top line being flattish. And then the staff cost increments, etc., further hit if your revenue hasn't grown.
Okay. Okay. And sorry if I'm repeating this, the revenue flat is flat volumes and prices, or it has like what is the breakup there? If you can just help us.
Let me see if I have the volumes. PCLT volumes are slightly up.
Okay.
We have a big decline in the Space Master tires, which is that special category tires, which is not market linked. It is largely linked to the fact that it's manufactured in a high cost plant, and hence as contracts are ending, the customers are not renewing those contracts. So
Okay.
That's a big decline of almost 40%.
Oh.
And agri market continues to be sort of weak. And then similarly, the TBR also has had a negative market growth. So that's why the overall sense, the PCR part, which was still positive and we outperformed the market, but the other segments pulled it down.
And I'm guessing that PCR has a better realization. That's why your revenue has ended up still being flat YOY.
That's correct. And there is further an improvement in the mix, which we continue to drive, which is the UHP proportion is now in the high 40s.
Okay. Okay. And secondly, just on the commodity comment that you made. Now, we saw natural rubber ease off a bit, and then I think it has stabilized and maybe slightly moved up. But the benefit from crude falling, which has happened in the last 3 months, the crude related derivatives, are you still to see the benefit, or this comment for 2Q incorporates some benefits that you're seeing in the crude derivatives also?
So, I mean, some of the benefits is incorporated because the contracts are signed ahead of time. So we expect that benefit to come through, and hence the only element of risk there is the exchange rate.
Yeah.
Because that will hit us on a spot basis. Your comment on natural rubber is absolutely right, because even on a sequential basis, natural rubber actually was up 3%.
Okay.
We saw reduction in synthetic rubber and nylon fabric.
Okay. Thank you. And just lastly, slightly more, question on the medium term. So, when you had put out that FY26 plans, obviously you had some ROCE targets as well as margin targets. You had actually achieved the ROCE targets, before time in, sometime in fiscal 23-24 itself. But obviously the market has changed. So, how should we think about that 15% number in the context of where you are right now? And realistically, based on whatever assumptions you can make, in the best of your knowledge, when can we see that return to 15%?
So if the current market conditions, were to continue, which is, let's say, raw material tailing off a little bit more, we should be returning to that. Right now, in fact, in the current quarter, it is the Europe operations with market challenges which have pulled down the overall returns. So I would say, while we are not there in near term, but medium term, definitely return to that 15% is possible. And as we get back on the table to look at our targets and vision for the next 5-year period, starting from next fiscal year, we will see whether the target should remain at 15% or higher as we go forward with a very different manufacturing mix.
Plus, I think in Q2, you will see a much better performance on Europe side.
Okay.
So things are looking better than before, unless there's a geopolitical issue with the US. But things are looking better, and I can see Q2 results on revenue side being much better.
Okay, great. That's good to know. I'll come back in the queue.
Thank you, Amin.
Next question is from Raghunandan. Raghunandan, you can unmute your line and go ahead.
Thank you for the
Hi,
opportunity.
Raghu.
Hi, sir. Sir, on Europe side, you have highlighted focus on sales mix improvement, cost optimization, and Q2 is also expected to be better. How do you see the broad range for EBIT margin for FY26? Can it be flattish on a full year basis compared to last year? And also your thoughts on the restructuring efforts. How do you see what would be the timeline when they will reflect in the margins? And if you can give some quantification of the benefits we can expect, say in FY27 or 28.
So, Raghu, yeah, as we've stated repeatedly, we do not give out margin guidance. So, on the first question, I'll have to say that we will not comment on that. On the second one, we expect to finalize the consultation process with the Works Council within the current quarter. This is also a period when there's a three weeks of annual maintenance leave when people also go on holiday. So the consultation process will resume towards the end of August, and we would hope to complete the same within this quarter. The intended decision of closure, which will get finalized as part of this consultation process, is towards the summer of next year. So it is still a significant period away. The expected benefits, etc., still too early to quantify, but yes, they will start flowing in from FY27, nothing in FY26.
Got it, Gaurav. Thank you. My second question was on India replacement. How has been the TBR, PCR performance, and how do you see the outlook ahead? Replacement, you indicated that you broadly performed in line with the market. How is it between the categories?
Sure. So on TBR replacement, Raghu, we grew mid-single digits. Passenger car replacement was low single digits. We might have been slightly behind market on the passenger car replacement, but TBR slightly ahead. And that's why I said over the two main categories, we were in line with the market growth.
Got it. And the share of Redestein, given that you highlighted that it is the highest ever volume, so how should we look at it within PCR? How would be the share of Redestein?
It is still quite low, sorry, not slow. I don't have the exact figures here, but the percentage proportion would be, I think, still in single digits.
Got it. Just the last one. Can you share the commodity prices for the quarter?
Sure, Raghu. Just a minute. Natural rubber was around 210, synthetic rubber 180, carbon black 120, and steel cord 160.
And the blended RM basket?
Blended RM basket would have been around somewhere 166 odd.
Got it. Thanks so much, Gaurav. Wishing all the best.
Thank you, Raghu.
Next question is from Mumuksh. Mumuksh, you can unmute your line and go ahead.
Yeah, thank you, sir, for the opportunity. So
Yes,
I just
Mumuksh.
want to understand, firstly, on the Europe researching costs, sir. We have done around 500 crore of cost over last 2 quarters. So just want to understand, is this now the cost complete, or there could be more further cost in coming quarters, sir?
So, Mumuksh, what we took in March was based on a desktop study of asset impairment, which is a non-cash charge. And again, while from a business perspective, we would have said that it should be taken all in one go once we have clarity. Our auditors and accounting standards dictated that we make an assessment immediately. The second one, which has come in the current quarter of about rupees 370 crores, is the actual cash payout that will happen if all the employees that are currently there are paid as per the signed social plan. Now, if an employee leaves in between, then that cost will not be incurred. We will still have to do a more thorough assessment on the asset side of things. We will send in a team to go through the entire asset list in detail, including a physical examination. So there might be something more on the asset impairment side.
Got it. Got it. And so anything on the land sale, sir, or will they involve any land sale which can give a cash in, you can receive some cash for the land, sir, for the plant?
Too early to say, Mumuksh, because we want to first concentrate on the entire consultation process with the Works Council. It is a tough emotional decision, take care of the employees, and then come to the other aspects of this decision. So too early to say on that.
Got it, sir. So secondly, just want to understand how do you see the new competition which is planning to come build in India for TBR and PCR segment, and just want to understand how do you see if any impact on the talent for your team or the retention of the network, sir?
We will have more competition. The competition will take time to make not just an entry but establish themselves. Both TBR and PCR are technology products, and apart from technology, establishing a vast distribution network. But yes, it will add to the competitive intensity and it will add to the fight for talent.
Right, right. And also, any challenge on network side, sir, to hold on to dealers, or there could be, is there a challenge around network also, sir?
Gaurav, let me answer that. So I don't think, I mean, it depends on the product and the brand. Today, Apollo has a very good brand equity in India, both in TBR and PCR. As you know, we are leaders in PCR and TBR. So we'll continue to come out with new product launches which serves the dealer network. Yes, there is attrition, but there is also add-on. Every month we are adding dealers. We are also going into the rural market. And so expansion of distribution is the core strategy for Apollo going forward. And especially in the rural markets, that's where the growth is going to come. And on your keeping the talent, you would have seen in our balance sheet that we've also come out with the ESOP scheme recently. So to the top tier of the management, tier 2, tier 3, tier 1, we've given ESOPs across the board. So those are the talent retention tools that we are introducing into the company.
Got it, sir. Thank you so much for the answer. And sir, lastly, sir, just want to understand, in terms of the volume growth, sir, when do you see our volume growth catching up with the overall industry growth, sir? There's been last 1 year of underperformance. Just want to understand, based on your customer order wins, how do you see that growth coming back to the normal level, sir?
So, in India, we have been growing at the market rate. Competition has obviously grown in two, three-wheeler, where Apollo is not a significant player. And therefore, when you see the revenue numbers, there are double-digit numbers coming off competition, which is primarily driven by two, three-wheeler. But as far as truck and PCR is concerned, we are putting in all efforts to try and see that we achieve a double-digit growth, and you'll see that in quarter 2.
Got it, sir. Thank you so much for the opportunity.
Thank you.
Thank you.
Next question is from Arvind. Arvind, you can unmute your line and go ahead.
Hi, good evening,
Hi,
sir.
Arvind.
Thank you for hi, good evening, sir. Thank you for taking my question. Sir, first question would be more on the accounting part. There was a big exceptional around 3.7 billion rupees. But versus that, when we look at your taxation, that seems a little different. So, two parts to it. First of all, what should be the tax rate going forward? And secondly, if one was to see the post-tax implication of this exceptional, what would that be?
So the tax rate for our Europe operations usually, if I remember correctly, Arvind, is around high teens, which is a mix of Netherlands tax rate and Hungary tax rate, and then smaller component in other geographies. So that will continue as a normalized thing. We will get the tax benefit of this significant exceptional items, including if there are carry forward losses. So to that extent, we get the tax shield on the cash out.
Got it, sir. Yeah, I was talking from that perspective only. If we look at the PBT around 4 billion rupees and then 3.7 billion of exceptional. So on that taxable profit, the actual tax of 255 million seems a little high on the higher side. So just, how should one look at the blended consolidated tax rate going ahead?
So if you take out the exceptional item, that's what I said, about a high teens is the tax rate for the European operations. Difficult to give you a simple picture because Hungary is high single digits. There are other geographies because we have subsidiaries in other European entities, and each of them have their different tax rates based on the profits made, whether it's Germany, France, etc. The largest one, which is Netherlands, our tax rate is about 20%.
Got it. Thanks so much for this. Just one more of a clarification. The blended replacement demand, you said, was volumes were up low single digit and OEM was up mid single digit. Was that because the presentation had low to mid for both of them?
Yeah, replacement was low single digit, OEM was mid single digits.
Got it. Thank you so much, sir, for taking my question. That's all from my side. Thanks so much.
Thank you, Arvind.
Next question is from Joseph. Joseph, you can unmute your line and go ahead.
Thank you. I had three questions. I'll take one by one. The
Yes,
first
Joseph.
one is on the European operations. So when I look at the last 3 years, typical seasonality that I see is that the average revenues in, say, 2Q, 3Q, 4Q, in euro terms, is typically about 20% higher compared to 1Q. A typical seasonality that we have seen every year. So when you said that this year also the subsequent quarters would be better, are you referring to better YY trends or are you talking about sequential improvement which happens every year?
So Q2, Joseph, we are talking about more the seasonality factor. The market as of now is still negative. So the improvement in the top line that I'm talking about is more a seasonal factor, but at least it provides a better operating leverage coverage, which should then impact the margins that Neeraj talked about. The expectations of growth coming back to a positive territory is still a little away. We would hope that in Q3.
Understood. Thanks. The second question that I had was on the Indian operations OpEx line. So last year, you were averaging about 800 crores per quarter in terms of OpEx. And I recall very clearly that you had mentioned you will try and cut that down with lower travel costs, etc., etc. This quarter, we have seen a good result. There is a good sequential drop in OpEx. So are these efforts to bring down OpEx bearing fruit, and hence this kind of run rate is sustainable? Or is there a risk of it jumping back to the old 800 or?
Currently, we would say, Joseph, these levels are sustainable. We did, apart from the cut on travel and various other costs, the only one which was cut also very sharply was the advertisement and promotion spend. At some stage, that will have to be released back for the sales growth. Other than that, the other costs are very much which should continue at the current levels.
Understood. And Gaurav, the last question I had was Reifen.com, if you can share the revenue and margins for the quarter.
Yes, just a minute.